Hello, YNABers. My name is Jesse Meekum, and this is podcast number 77 for You Need a Budget, where we teach you 4 rules to help you stop living paycheck to paycheck, get out of debt, and save more money. Always wanting to save more money. Today, I want to end the debate that is incessant when it comes to traditional or Roth IRA. Some people say IRA. I can't do that for some reason. I'm like the guy that says NASA for the NASA situation. NASA, NASA, IRA. I'm going with IRA. And if you don't like that, we're going to be talking about it a lot. So you may want to change the channel. But people debate constantly the difference between Roth and traditional IRA. They look and say, well, if you deposit, if you invest in a Roth IRA, you pay tax on that money that you invest now, and then it grows tax-free. And then when you withdraw the money, it's all tax-free. The investment you put in initially, because you already paid tax on it at the beginning, and the growth that that investment experienced while riding around in that Roth investment vehicle. On the flip side, the traditional IRA is a tax-deferred vehicle in which your investments ride around. So you would say, well, I'm going to invest that money, and you deduct that money from your tax on your 1040 for that year, saving yourself some taxes that you would have otherwise definitely paid. Then that money also grows tax-free until you withdraw it, at which point you pay money on the entire withdrawal, what you deposited or invested originally, that was deferred from taxes, and then the growth that you had experienced that was also deferred. Now, everyone would say, well, naturally, the Roth is better because the taxes, or the growth isn't taxed. But that's not mathematically accurate. If I were to use really, really simple math, I better get my calculator out for this one. Follow along. Let's say that you were only going to contribute $1,000 to your... You had $1,000 you could contribute to your Roth. So you put in $1,000. You're taxed at 25%, though. So that $1,000, you really only could put in $750, right? So you invest the $750, and it grows to whatever. The traditional IRA that you had the $1,000, you don't have to pay taxes on that $1,000. So you end up contributing the entire $1,000, $250 more than the Roth. They both grow at the same exact rate, same everything. At the end of the day, they will have, provided that your tax rate is the same as when you were going in, they will have the same amount. Now, this opens up the question, and I'm going to loop back around to why the behavioral side of this is totally ignored. But this loops back around to the whole idea of, well, if your tax rate will be lower when you're in retirement, then you should definitely put it into a Roth. Okay, makes sense. If your tax rate will be higher in retirement than it is now for your contribution, then you should be putting a traditional IRA. Okay, that makes sense. It's too bad that you have no idea what your tax rate will be. And I looked this up in the investing course that I was working on. The tax rate is all over the board. When it first started, you would have made, I think, $425,000, 1913 or so, maybe 1916. And you would have been taxed at 1%. Then, in 1944, that same person making $430,000 of inflation-adjusted dollars, right? They would have been taxed at 77%. Now, I think it's somewhere like 35%. Okay, the highest rate. We don't know what the tax rate will be, and you can't pretend to know. We don't know what Congress will do tomorrow, let alone what they'll do 25 years from now when you retire. So the whole debate of will your tax rate be, I'll admit that the tax rate will affect what, the financial ramifications of your decision, but you have no control over the tax rate. You have no insight into what it will be. So you should ignore it, because doing anything else but ignoring it is kidding yourself. So that removes the retirement tax rate from the discussion completely. Now, let's go back to that $1,000. You would not sit there and say, well, I have $1,000, but I'm not going to deduct it, so I can only invest $750 because I'm doing this Roth. You would just say, well, look, I've got $1,000. And then you would invest it in your Roth. You would not, on the flip side, with your traditional IRA, say, well, I've got this $1,000 here, right? You got the $1,000, you're staring at it in the bank account, budgeted for, ready for retirement. The $1,000, you would not say, well, that's $1,000, but I'm actually going to save tax money when I invest that $1,000. So my actual contribution should be $1,333.33, because if I invest $1,333.33, I will save myself $333.33 in taxes, bringing, right? I mean, that's what you would do because you get that deduction. No one does that. Nobody does that. That calculation, if you want to know, was $1,000 divided by 1 minus your marginal tax rate. So in this case, our marginal tax rate is 25%. So it's $1,000 divided by 0.75. That gets us to our pre-tax situation amount that we could invest in the IRA. Nobody does that. You can see why. It's confusing. My brain's oozing out onto my keyboard a little bit here. So at the end of the day, because nobody does that, we can't consider, honestly, the fact that you would invest more in your traditional IRA because it's tax deductible. You wouldn't do that. You would just look to see what you have to invest, and you would invest it. So why is the Roth better than the traditional IRA? It's better because the limits are different. It will say in all the literature you read that an IRA, Roth or traditional, I think our limits are like $5,000 or something. I'm not going to spend the time to look it up. It'll just change tomorrow or whatever. But the limits are $5,000, right? So you actually can contribute more to your Roth. It says that the limit is the same. It says that the limit for both is $5,000. And that's true. You can only contribute $5,000 into a Roth or traditional IRA. But to get that $5,000 for your Roth, you had to earn, because you had to pay taxes on already, you had to earn $6,667.67, assuming a 25% tax. So you are actually allowed to contribute more to your Roth because that will grow tax-free, and you're capped at $5,000. You can't go to the government and say, hey, listen, you said $5,000 is all I can invest, but if I invest $6,667, that's the money I save, that $1,667 above $5,000 that I save. I want to be able to invest that too, so that the Roth and the traditional are equal. Nope, they're not. Because the Roth is tax-free, and you pay the tax up front, and the limits don't reflect that fact, it's better, because tax rates and your retirement are off the table, to invest in your Roth IRA. Maybe I should have Casey on here at some point. Maybe he could discuss that a little bit more eloquently. But that's my take on it, and that's why I like Roths. If you have a 401k with a Roth option, you should be doing that one. It's just the same thing. 401k or Roth 401k limits, they're both whatever they are. They're both the same number, which means you technically can invest more in the Roth, and you should. Take advantage of that tax-free growth, retire filthy rich, sipping some kind of a drink on the beach. Not much of a drinker, so I couldn't pull one off really quick. Until next time, follow YNAB's 4 rules, and you will win financially. You have not budgeted like this.